Welcome back to IME 315. In this lesson, what I'm going to cover is the cost of labor and overhead as a part of the fully allocated cost of goods sold. Now, the first section here is to talk about standard times and review time study analysis. And I'm going to go through this fairly quickly. The slides are pretty much self-explanatory, but it's what we did in IME 223. And if you didn't take 223, the whole point of developing a standard time is to find out what the appropriate time is on a standard basis to build a widget. And so when we do this, where I'm going to go with this again is we're splitting this into direct labor equals the cost of material. The cost of a unit, is direct labor plus materials plus overhead. We talked about materials in the prior video. We're going to talk about the direct labor and overhead in this slide section. So one of the things when we talk about direct labor, and I'm sorry for moving moving the video from side to side, but we need to do time studies, work sampling. We need to get the times for each step of the manufacturing process. So we've come up with a time, like an hourly time. And then we find out we need to apply that time to the cost of the employee. And so what I'm going to talk about is the sampling and the work sampling time with the time studies, and then that's going to go quickly, and then go through how we calculate the employee cost. We need to incorporate the direct rate of the employee, either on an annual basis or an hourly basis. Vacation, we need to incorporate taxes, and we need to incorporate benefits. And that gets us to the full cost of direct labor. So I'm going to go through a quick time study analysis review. I want you to look at these slides. It's more of a review as opposed to what we're going to cover in this class. Again, the point of the time study analysis is that we're getting a standard time to make a product. So a standard time to make a widget. And so these are the various steps we have to go through. So watching the operations, breaking the operations down into its basic elements, determining how many cycles to time the elements, and then take it through these final steps, including allowances, and calculate a standard time to build something. We want to make sure that when I say methods are optimum, we want to make sure that the situation is appropriate. We don't want to do it when there's been a power failure or there's been an upset in the process. It's got to be a standard time, a typical time. And we need to look for unusual elements in our sampling when we're watching the operations. Do we have to refill the raw material stop? If people stop by and interrupted the process, things like that, and we need to back those things out of the calculations. When we determine the elements, they have to be short enough to be valuable. So it can't be something that can, 15 minutes. It's got to be long enough to work a stopwatch, so it can't be 5 seconds. Maybe the minimum is a 10-second one, maximum really depends upon the operation. And we have to have clear start and stop indications. Now we want to talk about how many we want to sample. 30 is not as good as 300. However, 30 is fairly common when you sample for different cycles, and you can come up with very good averages using 30. You can apply statistical measures to it. However, even 30 may not be possible. It just depends upon the limitations of the process. Then we time the elements. We want to time a trained operator, not a new operator. And we want to let the operator and the supervisor know that we're going to be doing this so that they aren't surprised. And then we're going to look for unusual elements. And we want to keep notes on each cycle, so if there's an inconsistency, we can look back at the notes and see if we need to back out that observation. And expanding on that, we calculate the average time for each element. We throw out any obvious outliers. We add all the average element times together that we're going to keep to come up with an overall time. And then we basically, I want to say, rate the operator, if you will. Is this a 100? That's normal. Is the operator working slowly? Is he working more rapidly? Because you're observing him. Is the operator trained and new employees, learning curve? Is it the most skilled employee and not the typical operator? So you want to see, should we rate this as 120 as opposed to 100, because the operator may be the most skilled one on the line. Then we determine allowances, and that's going to be a percentage. We have allowances for break, allowances for tedious or stressful work. You just have to step back. And maybe what we're observing isn't doable over an entire day. So we have to factor in these allowances. And then we calculate the normal time for a cycle. And basically, we take that from our rating, which I showed the example was, 100 is normal, 70 is slow, 120 is fast. We basically turn that into a percentage and multiply it by the observed time. So if our observed time was 30 seconds and the rating was 70, then the normal time, I think I have that inversed. I think it should be 100 over 70. The normal time would be 100 over 70. And then the standard time, we factor in the allowances. And remember, the allowances are provided as a percentage. And so that's how we get to the standard time for an operation. And it's going to be seconds per unit. Now, we do that to determine what the true cost of labor is on an hourly basis, and that's the direct, but just the hourly time. Let's look at the cost of labor, the actual cost. So we've talked about the time. Let's look at the cost of labor to an employer. Okay, so we have a direct rate. We need to factor in the benefits and taxes. Now, when we look at taxes, there are three types of taxes. There's federal taxes, state taxes, and workers' compensation, which is a mandate, not a tax. But this is the cost of labor to an employer. So these are taxes that the employer pays either to the federal government, the state government, or an insurance agency, the workers' comp, that is above and beyond what's paid to the employee. Types of federal taxes, and these are paid by the employee, not the employer, not the employer. I'm going to get to that in a second. But Social Security tax, Medicare, federal unemployment tax, state taxes are going to be different from state to state. I'm going to show you what I believe is appropriate for California at the current time. Then there's state taxes, the state unemployment tax and employee training tax. State unemployment tax is different than the federal unemployment tax. And then there's a workers' compensation, and it's paid to insurance companies. It's basically if you get hurt on the job. And so it's different depending upon the type of job. If you work in an office, you're much less likely to get hurt on the job than if you work as a lumberjack, for example. And so those rates can be as low as 2 and 3%, all the way up to 35 to 40%. And that's of the salary. So this is a meaningful number. if you're working in the construction industry or the energy industry, something like that. Okay, so these numbers are accurate for 2022. I've updated them through 2022. Federal Social Security tax is 6.2% of the first $147,000 of income. Now, this is paid both by the employee and the employer, so the total tax that's collected by the federal government is 12.4% on the income. But right now, we're talking about the cost to the employer. Now, this is called a regressive tax. A regressive tax is a tax that the more you make, the less you pay on a percentage basis. So you can see if you make under $147,000, you pay 6.2% of your salary. It gets capped at 6.2% of $147,000. So if you make $300,000, you still only pay 6.2% of $147,000. And so that is what a regressive tax is. That's how Social Security tax is. The Medicare tax is 1.4% of your income. This is a just regular tax. It doesn't matter how much you make, it's unlimited. And I said regressive tax. There's one other type of term, progressive tax. And a progressive tax is typically what we have in federal and state income taxes. I'm going to get to those in a little bit. Progressive tax is something that the more you make, the higher rate you pay on additional income. The concept being if you make more money, you can afford to pay a higher income tax rate. Now, the federal unemployment tax is 0.6% on the first $7,000 of income. So it's not a huge animal. Now, states differ from state to state, but they have an unemployment tax rate. It typically varies from 1.5% to 6.2%, depending upon how the company retention history of employees is. So if you have a good retention history, you're going to pay a 1.5% rate. A poor retention history, you might pay the higher rate. This is in California. I'm sorry. If you don't have any history, the tax is 3.4%. And then it's on the first $7,000 of income. The employee training tax is a very small amount. It's 0.1% on the first $7,000 of income, and it's set up to try to support retraining new employees. Finally, we have workers' compensation. It's paid to insurance companies. A clerical job is about 3%. Manufacturing, depending upon the type of manufacturing, 9%. Construction, on average, is 11%. There's a difference between being a framer and being a roofer. Roofer is much higher than a framer. And then logging, about 35%. It's cost dependent, depending upon job risk. So let's look at an example. This is the cost, employee cost to a company. So let's say we're going to pay an employee $80,000 a year. So we've gone through our cost analysis that I just described, and we've come up with a standard time. We know how many units we're going to make, and we decided that this type of a job requires $80,000 a year. So the employer is going to pay a Social Security component of 6.2% of this $80,000, and that we don't get capped out at the $147,000. There's going to be a Medicare tax of $1,160. Federal unemployment, we're going to assume this is a new employer for purposes here, 2.38%. We've got a training tax. If we assume it's a manufacturing job, we've got 9% workers' compensation tax. So what we end up is this $80,000 job is costing the employer $93,603, strictly due to the taxes that are applied. And if you apply a percentage to that, it's 17%. So let's just assume that we have a $10 an hour employee. If we look at these as a percentages, let's see what we have here. And we just add up the percentages. It's about 17%. I show 20.75%, but it typically is around 17%. So we can use this as a proxy. We can say that a $10 employee, we pay an employee $10 an hour, but if we fully load the costs with taxes, it's $11.70 an hour. Now that doesn't include benefits. What if you apply, most companies, or many companies provide medical benefits. $8,000 a year is not atypical. It may even be more valuable than $8,000 a year. What about vacation? Most companies provide paid vacation. Let's say it's 2 weeks. Maybe you provide educational reimbursement. I got my graduate degrees at USC, and Union Oil paid for my tuition at USC for both degrees. And at that time, $10,000 a year might have been the right amount. Certainly a lot more today. Gym memberships, all these are benefits that are paid by the employer. And so if you factor these in, your benefit cost is an additional $21,676. You add that on as a percentage of the $80,000, you can see that's over 25% of the $80,000. And that doesn't include, that does not include the taxes that are paid by the employer. So if we put this all together, we look at salaries of $80,000, federal taxes, state taxes, employee benefits. We've got approximately a 44% increase. And as a proxy, when I do planning for a company, if you will, and I need to hire an employee, I put in a rate of between 35 and 45%, depending upon the state that I'm working in. So if I say it's going to cost me $80,000, I apply a percentage between 35 and 45%. In this case, it's 44%. So instead of using $80,000 as the cost to the employee, it's really $115,000 for the cost of the employee. So this is the cost of the employee. Now let's look at from the employee's perspective. So this is you getting a job. You're going to get $80,000 a year, and it's going to cost the company $115,000 a year. Now, from your perspective, you're going to be paying federal income taxes. Incremental deductions from income are allowed. I'm going to take you through a small example, but it really depends upon your individual tax situation. But this is a progressive income tax. That's why it says incremental, and I'll take you through that in just a second. And we have Social Security taxes and Medicare taxes, just like the employer does. The state, depending upon the state, has incremental income tax and deductions from income. That's California. Some states, Nevada, Texas, Florida, and there's others, have zero state income tax. And that's a whole other animal that I discuss in the graduate class in this, is what are the implications of states that don't have income tax in terms of attracting employees. And then there's state disability insurance. If you're disabled on the job, it's 1.1% on income up to $145,600. That's in California. It varies state by state, and this is current through 2022. So if you're a single individual, and recognize that there's other tax tables for married and married filing jointly, but if you're a single individual, this is what state tax tables look like in 2022. And so this is a progressive tax rate, tax table. The more you make, the higher your tax rate. So you pay these rates on each margin. So if you're in the $80,000 bracket, you're going to pay $4,808. I'm sorry, $80,000 income. You're in the 22% bracket. What that means is that your marginal income gets taxed at 22%. So you're going to pay this amount here, $4,808, which is 10% on $10,000, 12% on basically $31,000, and then you're going to pay 22% on the difference between 80,000 and 41,776. I'll show you that in a second. So this 4808 is basically 10% on this here, plus 12% on this piece here. So let's just say that we're able to deduct $10,000 from our income. Now that's just it's a tax ruling, not tax ruling, it's a federal income tax law that allows you to deduct certain things from your income. Let's assume it's $10,000 just for talking purposes, and let's assume we're going to make $80,000 in a year. We're going to get taxed on $70,000 for federal income purposes. So our income tax is going to be 10% on the first $10,275, 12% on the amount between $41,775 and $10,275, and 22% on the amount from $70,000 down to $41,775. So note that this is $70,000, not $80,000. So these deductions basically save us 22% on $10,000 or $2,200. So our federal income tax is $11,018. Social Security and Medicare taxes are paid on the full $80,000, not on the federal income tax number. So 6.2% on 80,000, 1.45% on 80,000. So our net income after federal taxes is going to be $62,862. Now the state of California, and this table is for the state of California. Every state has a different table. And like I said, if you're in Nevada, Florida, Texas, there is zero state income tax. But we are in California. We're going to be making, let's say, $70,000 to $80,000. So we're going to be in the marginal 9.3% bracket. Recognize here we're at $70,000 in the marginal 22% bracket. So marginally, if you're in California and you're making $70,000, $80,000, you're going to be paying 31% on each extra dollar of income you make. That's on income taxes. That doesn't even talk about Social Security or Medicare taxes. Now I'm giving you this information kind of as this is for your own knowledge. It's not really what we would do in justifying a project. When we justify a project, we look at the project from the employer's perspective. Now, this is just a different look at things from the employee's perspective. So we have the same situation. We're going to have $10,000 in deductions. The state of California tends to try to run their income taxes very similar to the federal government. We're going to pay state income tax of $3,512, and our disability insurance is going to be $880. So if we look at our $80,000 that we were making, we knock out federal income taxes, Social Security, Medicare, state income taxes, SDI insurance, we're making under $60,000. So we're paying over 25% in taxes to the various state and federal agencies. Now let's take this a step further. When I talked about the company making, contributing $8,000 a year for medical, that doesn't typically cover the full cost of the medical insurance. And so the employee typically has to make a contribution for the health care. And let's just assume it's $500 a month. That's not necessary. That's not low. It's not high. It's probably in the ballpark of what it's going to be. Now let's also assume we have a 401k. This is a tax advantaged program that the federal government to encourage you to save for retirement. And let's say that's $4,000 a year. You're going to contribute a little over $3,000 a month. That's another $10,000 a year that's coming out of your paycheck. Now this is going to be going into a savings account, but still your $80,000 a year job that was going to, if you get paid every 2 weeks, was going to pay you a little over $3,000, is now paying you $49,000 every 2 weeks. So there's an $1,100 difference in what your gross is versus what you're actually taking home. Now, let's look at this from the employer-employee perspective. And let's say that we forget about the benefits. So we forget about the health care, and we forget about the 401k, we forget about the vacation. We just work on the taxes. So the employer is paying $80,000 to the employee. He's also paying $13,600 to the various taxing institutions. So it's costing him $93,603. The employee is getting wages of $80,000. He's paying taxes of $20,370. Again, this is no benefits are included on either side here. So his take-home pay is $59,630. There's a difference of almost $34,000 between these two numbers. And that's what I call this a discrepancy. What it basically is, the difference between what the employer is paying and what the employee is receiving. And that's going to the federal and state government institutions to build our roads and whatever else is done with our income taxes. And I'm not trying to pass a judgment whether it's right or wrong. I'm just saying that if you're an employer, your $80,000 job is costing you $93,600. If you're an employee, your $80,000 job is netting you $59,600. From an engineering, economics, financial engineering perspective, we're worried about this piece right here, the $93,600. This piece right here was just for your own informational purposes. Okay, so where are we? We're looking at direct costs. We've got material costs. We've got labor costs. I've taken you through labor costs. Let's talk about overhead. We need to cover when we're making a product. We need to cover the supervisor. That's not a direct labor cost. Different consumables, drill bits, machining oil, rent, utilities, things like that. And overhead typically is a dollars per unit. Sometimes it's a dollars per hour calculation. And it's and this is how it's put together. You just calculate the total of the other costs that are not direct labor costs. And then you divide by the number of production units, you get the dollars per unit overhead. So overhead it's when you see on the income statement SG&A, some of your income statements had SG&A, selling, general, and administrative expenses. This is your marketing people, your HR people. We also have production overhead, indirect labor, indirect material, other expenses. Supervisors, indirect labor. This is indirect material, drilling bits, machining, other expenses, rent, and utilities. So these are the types of things that go into overhead. It's all the other stuff that's necessary. So these are examples of SG&A. These are examples of indirect labor, indirect material, examples of other expenses. Now, sometimes, I don't know where everything went there. Sometimes overhead is treated as a percent. So we'll just say, from an overhead perspective, we're going to say it's 20% of the direct labor cost. It depends upon the company. When I'm doing this startup company that I had to come up with my cost of all my costs, and my overhead for this SG&A was explicitly spelled out, and my overhead for indirect labor was explicitly spelled out. My indirect materials, I actually put a percentage in for those. My other expenses, I explicitly spelled them out. So it just depends on the company you work with and how much detail you want to work. Okay, so this concludes the lesson on costs, and it's material costs and labor costs. There's one more lesson for this week, and it's going to be other types of costs. And it's not, but you have enough material now to complete the homework. And I'll explain the other costs, which will be used throughout the rest of the quarter in the next lesson. Thank you.